Hello and welcome to the Business Talk podcast. I'm your host Deepak. We are delighted to welcome Professor Baruch Lev from NYU Stern School of Business and Professor Feng Gu from the University of Buffalo School of Management to today's podcast episode. Both distinguished faculty members will share invaluable insights from their research-driven book, The M&A Failure Trap: Why Most Mergers and Acquisitions Fail and How the Few Succeed. Professor Baruch Lev is the Philip Barnes Professor Emeritus of Accounting and Finance at New York University Stern School of Business. He previously held positions as a Professor of Accounting and Finance at the University of Chicago, Tel Aviv University, where he has also served as a Dean of the Business School, at the University of California, Berkeley, where he was a professor at the law school. Professor Baruch has been involved in numerous consulting projects for major international companies and has served on various governmental committees, etc. He has also testified before the US Senate and Congress. Throughout his extensive research career, which includes 7 books and 125 research studies published in top academic journals, Professor Lev has frequently challenged existing rules, regulations, and widely accepted public beliefs. His work has been cited nearly 65,000 times by other researchers, according to Google Scholar. Professor Lev earned his PhD and MBA from the University of Chicago. He is also a certified public accountant. Our second distinguished guest on today's podcast episode is Professor Feng Gu. Professor Feng Gu is the Chair and Professor of Accounting and Law at University of Buffalo School of Management. Professor Feng's research interests encompass the measurement and valuation of intellectual capital, intangible assets, corporate management and reporting of investments in intangibles, and firms' voluntary disclosure of both financial and non-financial information. He has published extensively on these topics in reputed academic journals. His research on the usefulness of knowledge-based measures has been cited in Fortune, Business Week, and Harvard Business Review. Professor Feng Gu earned his PhD and MA from Washington University and his BA from Beijing University, China. It is truly an honor and pleasure to have Professor Baruch and Professor Feng on the podcast.
Thank you. Thank you for having us.
Thank you. Thank you for this great introduction.
Professor Baruch and Professor Feng, to begin, could you share the primary reasons why 70 to 75% of all corporate acquisitions fail and what your research has uncovered about these common pitfalls?
Maybe I'd start. I would say that most acquisitions fail because they were not necessary in the first place. Acquisitions are extremely costly, extremely expensive. You have to pay 30-35% over current market price, sometimes even more, to entice the acquired company, the target, to give up their shares. You have to pay huge amounts of money to all kinds of intermediaries, investment bankers, and so on and so on. So you start with a very expensive investment that has to be paid off. The second point is that acquisitions are very risky. I like to compare acquisitions to human organ transplants, where a foreign body, a liver, a heart is transplanted into another human being. In acquisitions, another company, another business is transplanted into the buyer, and they share most of the risk. You have to find the exact donor to match, and it's very difficult to strategically find a good target. Also, the body, in many cases, rejects the transplant, and in acquisitions, the acquired company or employees of the the buying company really rejects the target in this case. So that's why doctors use organ transplant as a really last resort. They will do everything Before that, they would give medications and surgeries, and all their last resort, they go to organ transplant. That's not the case in corporations. In many cases where a company starts lagging, stock prices is stagnant, profits are down, the first thing that comes to mind are to do a big transformative acquisitions. And because of the high price, the high risk of these things, many of them fail. And the main problem is that boards, managers don't seriously investigate the alternatives to acquisitions, and there are very good alternatives to acquisitions. And I let Feng talk about the alternatives.
Yeah, thank you, Baruch. You mentioned some very important reasons behind the large percentage of M&A failure we have documented. So this notion of acquisition versus alternatives is a very important concept that many managers don't fully consider. So in our book, we compared acquisitions with several alternatives, in particular internal development, such as R&D, advertising, brands enhancement, investment in human capital, IT, and so on. We document that over time, internal development actually has a much better payoff than acquisitions. Not just the dollar amount. We're also showing evidence of the advantage of internal development delivering more certain payoff over time. So this really increases the appeal of internal development versus acquisition. That's why we mentioned in the book in several chapters that the alternatives to acquisition has to be seriously considered by CEOs and their boards before they commit so much resources into the risky idea of making a big transformative acquisition.
Just want to mention that Amazon developed its awesome cloud operations, AWS, by internal development. They didn't acquire any cloud company. They just developed it internally, and it became a leading operations. Same with the German the German company Merck, pharmaceutical company, who developed its AI now in partnerships, in joint ventures with AI companies, rather than buying them. So our conclusion is that before you rush into acquisitions, consider carefully the alternatives. And because they are usually not considered carefully, you get this 70-75% failure rate that you mentioned.
Professor Baruch, in your book, you highlight strategies for improving acquisition decisions. Could you walk us through some key practices that can substantially enhance the likelihood of success in M&A?
I would start by saying that there are two major reasons for acquisitions. One reason is to regenerate growth, resurrect growth. A previously growing company, successful company, starts to dwindle a little, competition comes in, eating into its profit. So you want to acquire a company to regenerate growth. Most acquisitions in the food industry, for example, are made for this reason. The second reason is to change the business model. For example, a traditional insurance company wants to become an online insurance company. It can do it, as we said before, by developing internally, but it can do it by buying an online insurance company and enhancing it. So the first thing you have to do in order to make sure that acquisition work is determine exactly the strategy. What do you want to achieve by acquisition? And then start a very careful search process. Target companies are not low-hanging fruits. it's very difficult to find the right target for you. Second reason why acquisitions fail, or what you make in order to make acquisitions successful, is due diligence. Many companies don't pay much attention to due diligence. Years ago, Hewlett Packard, which was a juggernaut, acquired the British software company Autonomy for $11.5 billion. It turned out to be an empty shell. There was nothing, almost nothing there. A good due diligence would have identified it. So pay the right resources for people to investigate very carefully the target company. Third, and usually it's ignored by all managers, is that they are hyping the acquisition. They tell shareholders all kinds of incredible synergies that they can achieve. And then they need to show these things. We show examples how acquisition failed because managers press to show synergies. And I would say that the last thing that managers should avoid is holding on to losing acquisitions for too long. Usually you find out within 6-9 months whether the acquisition will work or not. If not, get rid of it, sell it, terminate it. But managers are loath to admit to failure, so they continue working on it, wasting resources. And so getting rid in time for a bad acquisition will also improve significantly the outcome.
Professor Feng, one of the most intriguing points in the book is how to predict the outcomes of a specific merger. So what are the most important indicators or tools that executives can use to predict success or failure in a merger and acquisition transactions?
Sure. So this is a very important point we're trying to make in this book. It's the most important takeaway for executives, board members, and investors if they have a chance to read this book. So throughout our extensive research, we developed a 43-factor model to predict the outcome of mergers acquisition. Out of these 43 models, we focused on the 10 most influential variables that would give us a very good idea ahead of time before mergers acquisition is actually implemented and tell us the likelihood of success for each individual deal. So these factors are all based on publicly available information. For example, the size of the acquisition, how big is the target relative to the acquiring company? What is the level of debt the acquiring company has to raise in order to finance the acquisition? Is the target a foreign company or domestic target? Is the target in the same industry as the buying company? In other words, are we talking about a conglomerate acquisition or same industry acquisition? What is the performance of the buying company before the acquisition? If the buying company is performing well, it increases the likelihood of success. What is the percentage of stock used by the buying company to purchase the target? The higher the stock percentage, the less confident the buying company is, and the higher the risk of this acquisition project. So we have a total of 10 factors included in this scorecard, and by summarizing the information from this scorecard, you get a very informative number. For example, if the score from the scorecard is greater than 0, a positive score, then your likelihood of success is substantially higher than if the score from the scorecard is negative. In this case, the likelihood of success is going to be substantially lower. We have a general version that can be applied to all industries. We have also tweaked the scorecard for several important industries like software, healthcare, financial service, technology, and so on. in order to reflect the special circumstances of each industry. So these industry-specific scorecard can be improved, can be applied to improve the prediction even better. So that's what we have in this part of our book. It's very easy to implement. Again, the most important idea here is you can run this very simple calculation before you spend a lot of resources on a very expensive and a risky acquisition. And the scorecard number would give you a very reliable prediction of this likelihood of success down the road.
Professor Baruch and
I would just like to
please.
add. I would just like to add, with your permission, that without boasting, this is really a unique feature of our book. There is huge literature on mergers and acquisitions. Our is not by far, it's not the only book or paper. It's a busy area, but to the best of our knowledge, no one has come with such a user-friendly tool that both managers and investors and board members can use to predict the outcome of acquisitions.
Professor Baruch and Professor Feng, your findings are based on a sample of 40,000 real-life merger cases. How did you go about collecting and analyzing such a vast amount of data, and what were some of the most surprising insights you found?
I let Feng talk about the sample and the data and everything.
Yeah, sure. So right at the beginning of this project, we had a plan and ambition to collect the most comprehensive data set for M&As around the world in order to draw generalizable conclusions from the industry experience, from what really happened in the real world. So we went out to look at all available data sources and really spent a lot of time and effort to make sure we get the most comprehensive data set of mergers acquisitions around the world. But mostly our data covers the acquisitions happen in the US because we require, in addition to M&A data, we require financial statement data and the stock price information to be available. However, we also have a decent number of foreign acquisitions in our database as well. So our database allows us to collect a comprehensive sample of 40,000 acquisitions over 4 decades from the 1980s until 2018. We stopped in 2018 because our measure of acquisition success requires us to collect data 3 to 4 years after acquisition is completed. So this would allow us to stop in 2018 and use the next 3-4 years to observe the outcome of acquisitions conducted in 2018. So that's essentially a snapshot of our sample used in this study.
We also use a very comprehensive statistical model, which Feng mentioned before, with 43 potential determinants of merger success or failure. And we basically let the data speak for themselves. It's a fact-based book. It's not a book based on our armchair hypotheses, recollections, maybe a few acquisitions that we did. It's fact-based.
Professor,
Yeah, you asked about, very quickly, you asked about the most surprising, at least to me, 2 things stand out. One is the huge failure rate that everyone that sees it is surprised. You know, people knew that many acquisitions fail, but most people thought it's maybe 30%, 40%. But we document 70, 75% failure rate and an increasing failure rate. Usually in management, as in other areas, you have a learning process. People learn from doing. Here you have some kind of an unlearning process. As time goes on, they do the same thing worse and worse. These, I would say, are the two most surprising things.
Professor Feng, the human element of merger and acquisition is also a crucial aspect of your research. What happens to executives and employees when an acquisition fails, and how can companies better manage the human side of these transactions?
Very important question. I'm glad you brought this out. You're right. This human element is often ignored in the existing literature on mergers acquisition. So in this book, we spent a lot of time and efforts to focus on two very important areas of the human element. One is executives, and the other one is employees. It turned out executives and employees have very different outcome in a typical mergers acquisition case. So for executives, typically when acquisition is completed, many of them receive a very large bonus. $5 to $14 million are very common just for completing the acquisition. No question asked about the outcome down the road. So that's a very lucrative deal for executives to go through. On top of that, executives are also compensated based on the size of the companies they manage. So by the nature of acquisition, most executives would receive an automatic pay raise because after the acquisition is completed, they would manage a larger company. The larger the acquisition, the more compensation increase they will get from this part of their compensation contract. So that's the deal for executives. Well, what if an acquisition does not work out? Well, what we saw in our research is also very surprising. So for executives, when acquisition does not work out, they often get a slap on the wrist, not a very severe penalty for them. Many of them actually get extension of their tenure because they keep making more and more acquisitions. So the boards are very accommodating by allowing them to stay on their helm and make sure these acquisitions go through, give them enough time to make sure each acquisition has the opportunity to succeed. So over time, these executives who keep making multiple acquisitions essentially extend their tenure. Acquisition has become insurance for extensive tenure on their CEO position. For employees, it's not as good as what executives would get. Many employees are laid off. So in a typical M&A case, we document in our book 5 to 7% of the employee workforce coming from the acquiring company and the target company. If you combine them together, 5 to 7% of them will lose jobs after acquisition is completed. So that's why a lot of smart employees, especially those on the target side, once they hear the announcement of acquisition, many of them would choose to leave because they know from the experience of others, that once their company is acquired, there is a good chance they will lose their job. Sometimes they may be relocated. They are not always getting the best deal of the bargain. So this raises the question about the challenge of how to ensure the human element is a success factor. For the buying company, the lesson is very clear. They have to figure out very early on in the game. They have to identify the key talent worth retaining and come up with strategies like signing bonuses, job securities, retraining, relocation packages, and so on. Without it, under the general pattern, a lot of talented employees would leave.
Professor Baruch, could you please elaborate on some of the most significant predictors of failures in mergers and acquisitions? How can businesses identify these warning signs early on?
I would say that one of the major things that you shouldn't do in acquisitions, which we show empirically that it's a losing proposition, is following the crowd. Maybe there are advantages in other areas for following crowds, but not in acquisitions. And in the acquisition M&A literature, you will find lots of advice, in sizzling markets, high markets, buy companies because your stock price is high. but the target stock price is also high in this case. Or buy in recessions because target stock prices are low and things like this. We show that in 2 chapters that practically all those supposedly opportune times to buy are essentially losers, and we identified the good times to buy. So one thing is don't follow the crowd. Second thing is don't get a large target. Example is AT&T acquisition of Time Warner a couple of years ago. Time Warner, the target is a giant company. Large targets are very difficult to integrate. You have to reassign thousands of employees. You create envy and rancor. In this case, those large targets usually don't work. Third is don't delude yourself that you can turn over a failing target. There are very few successful cases of turning around, not over, turning around corporations. So buy a target that it's at least well operating. We show that buying failing targets has a very negative impact on acquisitions. Feng, do you have some other things to add?
Well, early on, when I was introducing our 10-factor scorecard, I mentioned several financial factors that the buying company should consider at the time of making acquisition commitment. One is the large amount of debt a buying company has to raise. This is often ignored when CEOs are so overexcited about a prospect of acquisition in terms of how the acquisition is going to deliver a big transformation for the company to renew their business models and to regenerate growth. They often ignore this negative factor. The idea here is actually very simple. As Baruch mentioned several times, acquisition is a highly risky business. There's no guarantee the investment in acquisition is going to pay off as expected. So given the high risk of acquisition as a business project, raising a large amount of debt to finance it is an ill-advised decision. Many companies are dragged into this very difficult financial situation or even financial distress when they raise a large amount of debt to finance acquisition. We have several examples in our book to highlight this point. Another important factor that many buying companies often don't fully consider is their own financial health. I also mentioned this when I was introducing the 10-factor scorecard. In the opening part of a book, we actually document that over time, in the last 2 to 3 decades, the financial profitability and the performance of buying company has declined over time quite sharply compared to their industry peers. So when a buying company is starting from this position, they obviously have a lot of urge to turn things around. However, given their weak financial condition, we document in our book extensively that this is actually one of the most important contributors to the failure of acquisition. So each buying company should carefully assess their own financial condition before they decide to follow the crowd, as Baruch just mentioned, or just feel the urge to merge in order to turn things around as quickly as possible. This is often a not good recipe for success.
In the book, you provide a comprehensive review of both successful and unsuccessful real-life mergers. Can you share a couple of key examples and explain what made these deals succeed or fail?
I would say that the acquisition of YouTube by Google was an incredibly successful acquisition. Some call it the best technology acquisition of all times. And there are several things that made this acquisition such a success. First of all, the target We mentioned before that failing targets usually cause failing acquisition. In the case of YouTube, the target was a very successful, although small, but a very successful upcoming company in a new sector, file sharing. Google also made a very smart decision by letting YouTube operating separately until now, which assured that all the key talent of YouTube will continue working for it. It's also an example of a very large company buying a small company. Small is beautiful in acquisitions. So these are some of the reasons why this is such a great acquisition. I would say that an example of acquisition failure is Amazon's acquisition of the food retailer Whole Foods. I mean, ask yourself, what does a company with lots of branches selling vegetables and fruits add to the core business of Amazon, online retail and cloud operations, which highlights, I think, the folly of conglomerate mergers. You asked me before what were our surprises. One of the great surprises when you look at the data that we had, extensive sample of 40,000, is that in the last 10, 15 years, there is an increase in conglomerate acquisitions of companies in unrelated businesses, particularly by tech companies, and Amazon, Whole Foods is one example. Many of them are not doing well. Many of them are just waste of money. So here is an example of a good and a bad acquisition.
Professor Feng?
Yeah, I would add to what Baruch just mentioned, this very important notion that buy when you need it, buy when the target is really going to enhance your current offering. Here we saw a recent case of NVIDIA acquiring a much smaller Israeli company specializing in routers and connectors several years ago. So at that time, right before the takeoff, the current AI industry, NVIDIA saw the need of making sure its extremely powerful GPU units can be connected. So they needed a company producing connectors and routers, because this is not a homegrown business NVIDIA had. So with these clear needs in mind, NVIDIA look at potential target, and by the way, Intel and other companies were also trying to acquire the same target, because everybody saw this was the next step for the industry. So this is a good example of how good acquisition decisions should be made. You should not acquire unless you see how the acquired technologies and products will greatly enhance your current offering. In this case of NVIDIA's acquisition of this smaller company specializing in routers and connectors, immediately after the acquisition, the target's technologies and products were quickly integrated into NVIDIA's main product offering. So these days, when NVIDIA's customers buy tens of thousands of GPU units from them, they also purchased the routers and connectors made by this acquired target, because their goal, the customer's goal, is to connect these GPU, tens of thousands of them, in order to train their large language models used for AI projects. So this is a clear case of buying when you really need it, buy when the target products and technologies will really help make a difference in your current offering.
Professor Baruch, what are some misconceptions about mergers and acquisitions that executives often hold, and how does your research challenge these beliefs?
I would say the main misconception goes under the name of the overconfident CEO. And there are recently in finance research several very good studies identified by ingenious ways, which we don't have time to get into, an overconfident CEO. Most CEOs are confident. Overconfident means that despite past experience, past performance, you are still sure that you can take a target, sometimes even failing targets, turning it around. These studies found that about 30–40% of CEOs are really overconfident, over-optimistic about the consequences of the acquisition. Feng mentioned before that if they fail, they hardly get a slap on the wrist. So what do they care? So we also researched this overconfidence CEO. Example is Jeff Immelt at GE, who reportedly made 380 acquisitions during his tenure. And nevertheless, GE is in a very sorry state today. It's split to 3 companies. And it's basically lost its own identity. Somehow overcoming this overconfidence, which is a major role of the board in this case, restraining acquisitions where they are not really necessary, will improve the situation significantly.
Professor Feng, for executives and directors contemplating an M&A decision, what are some immediate next steps they should take to avoid falling into M&A failure trap?
I would make 2 points here. I think, first of all, this is a very important question. It's also one of the main takeaways from this book. Point number 1 is that all executives and board members should take the evidence in our book very seriously. For example, we show that 70–75% of all mergers acquisitions eventually fail. So when the failure likelihood is so strong, an average CEO and most board members should not operate under the illusion that I'm going to be exceptional. My deal is different than everybody else. I'm going to be more successful than everybody else. This is what Baruch mentioned, overconfidence issue. When the odds are overwhelmingly against you, overconfidence is not a good way to start. So that's number 1. Really take this evidence seriously. On average, the failure rate is overwhelmingly high, much higher than what an average overconfident CEO would think and acknowledge. Number 2 is the 10-factor scorecard we have already discussed in our conversation today. So this is actually a very practical tool for CEOs and board members to rely on very early on in the conversation and the consideration of acquisition. Don't just do it by spending huge amount of money without actually thinking about the likelihood of success. Again, this is not just based on some casual study, survey evidence or personal opinion. No, this is based on the research results summarizing the experience of 40,000 acquisitions worldwide over the last 4 decades. So there's a lot of truth and merit there. So the 10-factor scorecard is a beautiful tool that executives and board members can implement at the beginning of considering acquisition. Plugging the numbers there, once they have a clear idea about which target companies are going to acquire, what level of debt they have to raise, what percentage of stock they're going to use to finance the acquisition, what is the current profitability of the buying company. Very easy to do, 10 to 15 minutes. You get a very tangible outcome, a score. If the score is overwhelmingly negative, our advice is don't do it. If you really want to do it, think about alternatives and try to tweak the deal and see if the scorecard will give you a more positive outcome. So these things are not very expensive to do. They're pretty easy to implement. That's really the main takeaways we would like to propose here.
Professor Baruch, finally, what advice would you give to students of business and economics or investors who are looking to understand the deeper implementations of mergers and acquisitions?
That's a beautiful question. We start the book with some grim findings. As we mentioned during our talk today, the failure success, the increasing rate of failure, and this. But our book is not a pessimistic book. It's not a book about failure. It's a book about success. We have chapter after chapter with scores of examples of how to do acquisitions right. So my advice to students, to economists, don't shy away from the area of mergers and acquisitions because of the high failure rate. High failure rate provides you with a chance of succeeding in the corporate world, succeeding as a consultant, succeeding as an investment banker. Go into the area of mergers and acquisitions. It's an exciting area. It's a rich area. And if you do the right things, you will be richly rewarded. A good place to start, of course, is our book in this case. But whether you buy the book or don't buy the book, this is a good area to focus on. Just ending with a personal note, both my daughter and my son-in-law were working in mergers and acquisitions in very large and successful corporations. And I saw the joy on their faces when the mergers succeeded, when employees were happy, when the financial results improved in this case. So that's really a good area to apply, particularly to students and economists, to apply the tools that you get in school, but do the right things. And if you do the right things, you'll succeed.
Professor Feng, would you like to conclude?
Oh, yeah, this is definitely the most important takeaway we'd like future business professionals to have. Our book, as Bruce just mentioned, is not a negative book about a mergers acquisition. It's instead a book about how to do mergers acquisitions right. Our book offers a very significant number of useful takeaways for the future business professionals who will be working this area to have. So that's our hope of writing this book.
It has been an honor to have both Professor Baruch and Professor Feng on today's podcast, and we are incredibly grateful for the insights they have provided. Thank you both for your time, and to our listeners, we hope today's conversation has provided valuable perspectives on the complexities and critical factors for success in mergers and acquisitions. Thank you, Professor Baruch and Professor Feng, for your gracious presence and invaluable insights.
Thank you very much for hosting us. We appreciate it.
Thank you again for the opportunity. We greatly enjoyed our conversation today.
Thank you, professors.